And all of this adding up to a perfect storm of pessimism lately about U.S. stocks. For more on that, let's bring in Adam Parker. He is the founder and CEO of Trivariate Research and a CNBC contributor. It's good to see you. I mean, you've been making the point that you've been feeling sort of worse and worse about the position of U.S. stocks. You'd like that to change, but it just hasn't.
Yeah, I think, look, there's nothing better than if you can be a contrarian bull and then be right. And you and I have talked about that in the past, but it's really hard when there's this much uncertainty, when the earnings estimates are way too high. They're always too high, but they're way too high. And we haven't seen any of that behavior yet where stocks that are missing aren't going down. You asked Leisman a question I can actually give a factual answer to, or the poly market has 20 cents, so 20% chance that Trump gets rid of Powell this year. So for whatever that's worth, I think that's what you got to factor into your distribution of outcomes. You could buy it for 21 or sell it for 81 cents right now. And you and I were together election night when we learned the poly market was right a lot.
But do you think, I mean, how much do you think the escalating tension on that issue is weighing on stocks in concert with all the other things that we're worried about?
I do. I think that's part of today's reasoning. I think it's got to be part of today's factor. It's just more uncertainty, and we know that they don't have a great relationship. And part of what I struggle with, and I think we talked about this last week, is if there's a recovery on the other side of this, it's got to include, the tax extension, less regulation, maybe some AI-proof cases, et cetera. But, there's also a belief that investors here in the U.S. have been programmed to believe that recoveries are V-shaped. And I think the reason they've been programmed to believe that is because you've always had monetary and fiscal stimulus simultaneously in most of their investment lifetimes. And what if this time the Fed isn't expanding the balance sheet and they aren't cutting a ton and there isn't incremental fiscal stimulus? Then maybe the upside isn't, V-shaped, but it's kind of more of a slow grind higher. And that's what we're incorporating on our earnings outlook now, is that what I thought was 2026 earnings before, I now think is 2027 earnings. I think we've lost a whole year of earnings growth because the policies have already happened.
The further we go out on the, I guess I would call it the negativity curve, does it lessen the chances for a quick snap on a perceived positive social media post?
I would have said that, but 12 days ago you got, 10% S&P in 1 hour. And, if you and I went to school, they would tell us there's 10% returns in a year. So there's certainly buying power. If we start believing that we're going to resolve the spat with China in a kind way, the market will rip higher in a very short term on that news. And I think that's what people like me and investors I talk to struggle with the most. What historical period do I use to evaluate and then assume that's the current regime? I don't have one. There really wasn't a tariff war. And that's why when I look back at what happens when the dollar weakened, the playbook's been totally different, or what do I do? So I find that even though I want to be defensively positioned, I know I have to own some offense, because if we get some, tweet or whatever, the market can be up 10% in 1 hour. So I have to figure out, is it bombed out alternative asset managers where I take a shot? Is it, semiconductors where, a lot of them are down 30 to 50% from highs, and that's about an average semiconductor correction. And maybe the fundamentals are bad, maybe China's a problem, maybe inventory is high, but I know it grows above GDP long term, and I know they're going to rip higher when he makes a positive tweet. So people are struggling with how to barbell it. That's what everyone always calls it. How to find some offense and defense in this sort of current regime.
It's just a strange period, I guess, because it feels like to some degree there's a almost willingness by the administration to let the market get worse and let the economy get worse. But on the other hand, you're like, well, but I've got to believe that Trump put still exists at some point, and they do care about the stock market and the economy. ... Don't they?
Yeah. I mean, I think we learned that the Trump put was at a different level than we thought the consensus thought at the election. But look, one thing I'm really confident in is the price of forward earnings you pay for stocks is really correlated to the margins. And the thing that appears to be the case is tariffs are bad for the margins for a lot of companies. And so if the average company's margins go lower, the average company's multiple is going to go lower, and that's the bear case. To me, if you want to be contrarian, here's the consensus trades. One, U.S. stock market is not as good as non-U.S. I've seen 1,000 reports on the end of U.S. exceptionalism. Two, the dollar weakens. Everybody believes that, right? Three, that that the Fed will ultimately be accommodative, right? And so if you want to be contrarian, what you say is, I like U.S. equities more than non-U.S. at some point, and I don't think the dollar is going to weaken. I'm consensus right now because I think in the really short-term window, it's hard to see what breaks this. But medium to long-term, I still like U.S. equities more than non-U.S. equities because I think the main growth themes that drive GDP globally, the U.S. stocks over-index toward, whether that's AI semis or AI software or life sciences or electrification industrials or all those big broad themes with stocks we love, the U.S. just has better companies. So I think the U.S. will ultimately land at trading at a premium and ultimately outperform. But, you could be in a 3-month to 6-month period here where that's not the case.
But, some are trying to get ahead of it now. For example, UBS today upgrades U.S. equities to attractive from neutral. While downside risks do remain, we believe the risk of a more severe economic downturn is now more limited. We see U.S. equities as attractive and note that periods of stress have historically offered long-term rewards for diversified investors who look through near-term volatility. In other words, see the forest through the trees. If you're a long-term investor, why not now? That seems to be the summation of what they and some others are at least trying to suggest.
Yeah, I don't think that that's the consensus view, personally.
It's definitely not. Yeah. That's part of the point, right?
Yeah,
the consensus view is easy to be negative. It's definitely not.
Maybe that's a good call. Yeah, I agree. That might be a good call. I tend to believe that's correct in a 6-month to 5-year view. I'm a little more tormented in the next 6 months just because I could see the case where, we still have some things we got to deal with, the budget deficit, the dollar, the tariffs, China, et cetera. And I think if you're a CEO of a big company, damage has already been done. I think the only thing that we're trying to figure out is how big is the lagged effect between the damage that's done and when it hits earnings. I was surprised, I think we talked about it last week down at the stock exchange, that the bank earnings were better than I thought. I didn't think we really saw anything, 90-day delinquencies are getting worse, or we've seen a slowdown. They kind of said things were okay, and that made me think either there's a bigger lag effect than we thought, or maybe Q2 earnings aren't the trough. Maybe it's Q3. And if Q3 earnings end up being the trough, the market's got a big leg lower still, and I don't want to get too aggressive yet.
Let's bring in Malcolm Ethridge now of Capital Area Planning Group, Abby Yoder as well of J.P. Morgan Private Bank. Malcolm's a CNBC contributor. It's great to have you both. Welcome here to Post 9. What do you make of what you heard, and how does it mix, if at all, with your own view?
So there was a lot that went on there that we just talked about. But I think the last point on having this contrarian U.S. view resonates, at least with me. Like, I think everything that we've just heard about what could hurt U.S. corporates, right, like uncertainty, that's not a U.S.-centric thing. This is a global phenomenon that's going on in terms of this trade war, right? So uncertainty in the U.S. doesn't mean that there's no uncertainty in Europe and there's no uncertainty in Japan when these CEOs are making calls too. Mm-hmm. So, and I also think it's important when you look at actual month-to-date returns across the board, like Europe and Japan are outperforming, but it's all currency. Like, it's not because and that would suggest, the fundamentals there are not any better than in the U.S., right? They're like performing exactly the same. So I think when I do think the bets have all gotten way too bearish on the U.S. and isolating this because it's emanating from the U.S., but this is a global phenomenon, and companies around the world will feel the pain from this trade war.
I'm looking at an opinion piece in front of me that someone just sent me from Bloomberg. Markets are discovering the real Trump trade is, quote, sell America.
I don't know.
From where we came into the year thinking,
yes.
Well, this is going to be kind of a layup because, we have somebody and an administration who's, all in on this market and the economy, or whatever.
Or so we thought.
And but that's my point. And now you're back to the other free throw line, right, having to hit a 3/4 court shot for the prize. We didn't think it was going to be that tough. We're not Steph Curry, where it's like easy.
Well, and I don't know that I would say that investors are necessarily abandoning the U.S. Like, I don't think you're seeing that in terms of portfolio positioning. I think it's a wait-and-see mode to see what happens. And to your point, the relative starting positions matter, right? Like coming into the year, like you said, it was consensus to be overweight the U.S. And if an investor hadn't changed their asset allocation and let portfolio drift happen over the last couple of years, they were markedly overweight the U.S. So you've gotten like a little bit of this correction, which would help those portfolios from an international diversification standpoint. But I don't think it's an actual fling. I think it's a wait and see to see what happens, particularly with earnings.
Malcolm, what are we supposed to do with all of this? Batten down the hatches a little bit more, believe UBS, and say, okay, we understand risk. We understand all of that, but we think over the longer period of time that this is attractive now.
Yeah, I won't necessarily say that carte blanche across the entire stock market, but I will say at least with the NASDAQ being down 20+% firmly at this point from our February highs, I, as a person who loves to invest in software companies, can look at this and say, there has been this washout within the tech sector that maybe we still get a little bit more downward pressure from here. We lose a few percentage points, but we can say at least that that sector specifically has taken its medicine already. And it does look like a good time to start buying some companies that have been attractive to you for a while, but you've gotten caught up in the argument about valuations and everything else, knowing that these are still quality companies. I think the rest of the S&P, maybe, save for maybe real estate, you can make the argument that still has some way to go, right? We haven't gotten all the way to that firm 20% level that we'd like to see. But I do think that there are places, if you pick your spots, especially here in earnings season, where we're expecting CEOs to come out and give guidance where they're either making revisions or pulling guidance altogether. The companies that still reaffirm their guidance and have confidence in their annual projections and reaffirm that, they're going to be rewarded for that. We saw it happen with American Express last week. I know they're giving a little bit of that back today. We saw it happen with Prologis, right? It was a little bit of a surprise, and they reaffirmed guidance, and they were rewarded for that guidance with a 5% pop immediately after earnings. I think that those kinds of cherry-picked stories will exist throughout earnings season.
Abby, the other thing, I mean, you mentioned, earnings and valuation may be more relevant today than at any time in the past couple of years. Like we could justify higher than historical PEs on certain stocks based on what was to come in terms of AI trade, especially related to the Mag 7. Now, we don't really know where we're going. Mm-hmm. We suspect the economy is going to get worse from here. We think the probability of recession's higher than it's been in the last handful of years, certainly post-COVID. So how can we justify where valuations are today if we don't know where the end game is, but potentially it's much worse economically than now? Well,
look, markets are forward-looking mechanisms, and I think April 2nd was peak uncertainty in our view. And so we got down to 18 times, which is, historically where you see trailing 12-month earning multiples trough when you're in this type of market environment.
Even recession, though?
Yeah, on a trailing basis, right? So, and let's say on a forward basis, it was 18 and a half, which is in line with the 10-year average for the S&P, and given the changing constituency and the fact that, we really do still believe in this AI trade that's going on, that, does garner higher multiples, just given the change in the makeup of the index. I mean, I think to your point, the way we're reflecting that and the way that we're thinking about our outlook is the range of outcomes has gotten wider. We've heard this from a couple of companies when they've reported too, right? Like you're just in an environment with the range.
Like United gives two outlooks. Yeah. I mean, when have you ever seen that?
I know, but look, these companies are being rewarded for being honest. Like there's an element of okay, we are uncertain. Acknowledging that environment, I think, is being rewarded in terms of the outlook for these companies. And so that's the range of valuations. Like we were coming into this year thinking that we were going to see compression in valuations anyhow. This maybe widens that range. We were thinking 21 times, say it 19 to 21 times, depending on our number.
Malcolm, the other thing, if you look at what's happening within tech, there seems to be a view, and there certainly has been, that this trend is so durable that barring some really unforeseen economic turnaround or turn back, that the amount of money that the hyperscalers are spending on, NVIDIA's products and data center is not really going to slow. Maybe there was a little call into question about that a week or so ago with Microsoft, and now there's a note out midday from Wells Fargo talking about data centers and AWS from Amazon going on pause. That's the headline of their note. Not to current spending, but to new data center investments. Does that give you any level of pause as to where we might be going as it relates to that?
I think it actually gives me confidence more than anything else. And what I mean by that is I've been making the argument since so-called Liberation Day that what we really need to do is look beyond all of the noise and through all of the chaos to find companies that are of high quality, that we were willing to pay the prices for them 4 weeks ago. And we should be willing to pay these discounted prices 20, 25, 35% down now. And that spending that you're talking about within AWS, I'm basically getting an e-commerce giant with a cloud computing juggernaut and also a digital advertising soon-to-be juggernaut thrown in for free at these prices, looking at how much Amazon has come down, to use your example. So I think that within there, we have to consider the spending that they're committed to making on these growth plans in the AI revolution. They're going to pay off one way or another, but I don't have to pay up for that growth anymore. I had to worry about that 2 months ago. I don't have to worry about that buying into these companies now. And so I think we have to look a little bit further than just the next 2 weeks or 2 tweets and really focus on, do I want to own this company a year from now based on what I know that they're developing under the hood?
Adam, I'll give you the last word on that. NVIDIA's down a bunch, some of the other chips. You have the Huawei news today as it relates to their own chips and China, what that means in the bigger picture. How do you see it from here?
I think if the market goes up, I'm very, very sure semis will work. So if people want to take risk and they want offensive side of the barbell, they should just buy semiconductors. The stocks are down a ton, and the long-term, Malcolm's comment resonates. The long-term view of compute and what that means is pretty good, AI, et cetera. And so if you think the market's going to rally, if you think there's a tweet coming, or if you're just really defensive positioned and you feel like you've been right here recently, then I think you buy semis. I think that'll get you the offense you need. Tech has worked 19 of the last 20 times in the 3-month period after a market was down 10%. On average, it was the best performing sector, and then within tech, semis will participate. So, Malcolm likes software, I like semis, whatever. But I think tech will work, and I think semis will work if you want offense.
You want to just give me a quick thought on tech? I mean, I'll just remind everybody, NASDAQ's down 500 points, more than 3%.
Well, I mean, the Mag 7's trading at the cheapest valuation that it has in like 5 to 10 years. And when we're talking about this spend and whether or not it gets pulled back, I think the other way that you can think about it is if that does happen, the free cash flow profiles of these companies becomes much more attractive as well, right? There's a ton of cash that these companies have, how they're spending it. They've already invested a lot in terms of innovation R&D. I think that's something to keep in mind in terms of the pullback in spend as well.
We will leave it there. Abby, thanks. Adam, thank you. Malcolm, we'll see you soon as well.